please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Russell, good to see you again, and thank you very much for joining in today. Most people in the world seem to be quite worried about inflation returning and bond yields soaring, but you seem to have a different point of view that maybe the cookie will not crumble entirely like that. Maybe we'll have a growth scare rather than an inflation scare. Why do you have that contrarian point of view?
Yes, I do, and I understand why people have that view, and it's very much based on a Phillips curve view of the world, which is a tightness of employment. There were two things I'd put forward as the contrary view. One is the supply of money, which is not a very fashionable thing to look at these days. I mean, it comes and goes, but it's growing at incredibly low rates globally. So, for instance, let's pick America, the doyen of the global economy. It's only growing at 3.7% year on year. There's only 16% of all quarters since World War II where the supply of money has been growing that slowly. And if we look across the world, whether even it's in India, much higher number, but at the low end of the range. China, we're close to a record low growth in money supply. So I guess there's a simple question I ask people who are much more optimistic about inflation. I said, well, if you're expecting higher inflation, higher real growth and higher asset prices, which I think is the consensus view, how come we've got close to record low global money supply growth? Something doesn't add up. So one of the three variables that people are forecasting is likely to be wrong. It may not be inflation. It could be real economic activity. It could be asset prices. But it's difficult to see those other two adjusting without having some negative impact on inflation. The second one is just credit. When you have, and what we do have, is the highest level of debt to GDP ever in the history of the world. As we discovered with Lehman Brothers, you just need one significant mistake and the global financial system finds itself struggling. And as we know from Lehman Brothers, that's a deflationary rather than an inflationary adjustment. And people who watch me regularly on the internet will know that I will refer to Turkey as the next forthcoming significant default in the global system, a 434 billion default on the global financial system. I think that's big enough and to bring down growth expectations, to jar the financial system, and to have people looking more at the decline of inflation rather than the rise of inflation. So
you think that if an accident has to happen this time, it would be a country accident like a Turkey and not a financial system kind of an accident? Yeah, it's a very good question, because obviously, almost by definition, the word accident means it's very hard to work out where it will be and predict it. But the thing about Turkey is it's a clear and present danger. It's obvious that several of the largest companies in Turkey are simply not paying their debt. I do think it's a country. The BIS has also done some really interesting work with all this debt to GDP data, looking at growth rates in debt to GDP relative to trend. And they've picked out over 10 countries that they think could have a credit crisis. So this is interesting because most of them are emerging markets. Actually, there are two developed world countries they pick out as having such a high rate of growth and credit that they could be dangerous, which are Switzerland and Canada. But everything else is an emerging market. So there is evidence, I mean, to the extent that we can ever be objective about an accident, that there are quite a lot of places due an accident because of just the sheer growth in credit we've seen since the GFC. How imminent would it be, though? Because these things can carry on for a long time, protracted period of time before they come to fruition. Do you think it is really not at the door, or it can linger for much longer?
Well, you don't have to tell me that they can take a long time to come to fruition, because I've been, particularly in Turkey, I've been sort of saying for several years that it's coming to pass. Obviously, there are different stages of this, and what is the critical stage, the stage at which it's imminent? Well, it is simply when people stop paying interest on their debt, and that's where Turkey is now. And if the very largest companies in the country are really struggling, you can be sure that below that, the smaller companies are having real problems. The exacerbating factor, the thing that makes it more forecastable than usual, is that so much of the debt is in foreign currency. And we know from the United States or from Japan that domestic currency debt can be sustained for a very long time. And I think it's almost impossible to forecast, based on a domestic credit boom, just how vulnerable somewhere is. But the problem for Turkey and some other, particularly Eastern European countries, is the massive level of foreign currency debt they have and the falling exchange rates. So I think for those it's imminent. The interesting thing is what happens after that. In 1982 and 1997, when a major emerging market got itself into trouble, it changed capital flows for all emerging markets. Perhaps unjustly. I mean, I think it really is unjust that emerging markets get lumped together, but it still happens. Their assets are still held in silos. And then we'd see a capital exodus from other emerging markets. I wouldn't expect to find others being tipped over into insolvency, but I would expect them to be us looking at generally much lower levels of growth. But it's very difficult to predict then just the extent of the capital outflow that ensues post-Turkey and just how much strain individual markets will come under. But I am concerned. I mean, post-GFC, this is the biggest debt boom in emerging market history, and it is rare for all of that credit to be allocated.
The accident aside, are you seeing any signs from the biggest market, the biggest economy, that growth might be beginning to roll over and you will not get the kind of inflation scare that people are talking about?
Not particularly, and obviously I think mainly of the late 1990s when actually US growth was very good and inflation was coming down. We always relate it. I say the view of the world is very much a Philip Kerr's view of the world, that if the jobs market is tight, then that has to show up in inflation. On that particular occasion, in the late 1990s, America imported a lot of deflation, and the net effect was low inflation. So you can have reasonable growth without having rising inflation. I think that's clearly not the common view of where we are, but I think that's still very possible. And I don't have to go through for people watching the massive technological changes that are happening in the world that are inherently deflationary rather than inflationary. My concern in America really relates to financial markets more than growth, and that is what's happening in the Treasury market, where we have a fiscal deficit now running close to $1 trillion, so effectively doubled over the past 3 years. We have a central bank which this year will sell $380 billion worth of securities, rising to $600 billion next year. And through my entire investment career, really the US government has been primarily funded by foreign and local central banks. And the central bankers don't have to sell anything to buy treasuries and fund the government. They print something. And we are now living in a world where central bankers are net sellers of treasuries. And therefore, it all has to be funded by savers. They could be Indian savers, by the way. They could be Japanese savers or German savers or American savers. But I worry about the level of the stock market in a world where we have to liquidate something to fund the government. That's it. Savers have two ways they can fund the US government. Save more, which is bad for growth, or sell something else to buy treasuries. So I think the concern is not directly on US growth, but it's what might happen to other asset prices as they are liquidated to fund this huge supply of US treasuries.
Do you see a problem with the US corporate bond market at all, given the way yields have moved?
So if we talk about places where there has been excessive growth in credit, in aggregate, you can't point to the United States of America. I think everybody, though, who covers financial markets realizes that there is a section of credit within America, which is junk, which has once again been growing pretty quickly. Whether there's a significant enough catalyst to undermine cash flows to create a problem there, I think we just have to wait and see. There's a significant boost to US cash flows going on through the cut in the tax rate. And that bit of the credit market that looks susceptible, because it's just been, it's high-risk credit, does have this advantage of lower tax rates. So I think on that one, the jury is out. I don't have a very strong view on US high-yielding credit. It seems like an accident waiting to happen, but I don't see the catalyst for it happening. The problem, I think, is the discrepancy actually between that debt and emerging market debt. So we have a pretty significant sell-off in emerging market debt, and really it's fairly moderate in American high-yield debt. And I think that causes great problems for the world, because the Federal Reserve, I think, is much, much more interested in its own high-yield market than it is in emerging market debt. And I think twice in the last 5 years, the Fed has changed its monetary policy to help emerging markets. Once in the middle of the taper tantrum, when I think it was less aggressive than it otherwise would have been. And secondly, first quarter of 2016, when there was real distress in the commodities markets, I think the Fed backed away. And I think what's really, really important is this speech that Jay Powell made in Zurich last Tuesday, where he said that the Fed did not believe it bore any responsibility for capital inflows and capital outflows out of emerging markets. So if we have this discrepancy with US high yields seemingly stable, no issues with credit in America, but meanwhile, real credit issues building up in emerging markets. So that high yield debt market is really interesting. And it might sound like, well, if it begins to crack, we should be worried. But actually, if it begins to stay stable and doesn't crack, there's another reason to be worried, which is that Powell continues on his tightening track, regardless of the pain developing in select emerging markets.
But what's the path of least resistance for the US bond deal now? Is it 3.5% or 2.5%?
It is amusing to me that everyone's become an expert on the US bond yield since it got through the magical number of 3%. Suddenly, everybody's grandmother is an expert on the US bond market. And when you begin with a price and forecast backwards, I'm always kind of wary about that. I mean, I'm not saying that the fundamentals always help you, but it is good to start with the fundamentals and then go to the price. So my view is that we're quite close to the peak on the US bond yield, that it's an incredibly attractive level for many investors all over the planet, obviously mainly due to the incredibly low level of yields in Japan and in the Eurozone, and therefore it will begin to attract investment. That obviously is helped by the view that I don't think inflation is a problem. So I think most people look at the 3% yield and think, well, it's just reflecting a tight labour market and the inevitable rise of inflation. So for that yield to peak and begin to come down again, I think we are going to have to see some data which makes people question their outlook for US inflation. Or a credit event, and in any credit event, there is a flock to the world's most liquid asset. And United States Treasuries retain that position. We can go back through credit event after credit event, but if there's a sizable one anywhere in the world, Treasury prices will be bid up, not bid down. And the more we gear down our expectations for emerging market growth, then the more we look to lower inflation. So I think we're close to a peak. Despite the numbers I've just given you for this excessively large supply of treasuries. And I think one of the reasons the dollar is going up is that foreigners are finding it very attractive. If I tell you there's a country that's issuing a lot of debt, you might think, well, we'll have to sell US equities to buy all that debt. That's possible, but it's also possible that we sell German equities or Japanese bonds. And the fact that the dollar's going up does suggest quite a lot of capital coming into the US, and that 3% yield is proving attractive, particularly for foreign investors.
Do you have a view on the dollar? Do you see it strengthening further?
I do see it strengthening further. Everything I've said so far would suggest a strong dollar. As you know, exchange rate forecasting is probably the most difficult thing of all. They're the big, liquid, deep markets. But there are rare occasions when the dollar becomes really quite forecastable, and it is a credit event. It's a situation where the world starts to de-gear. In a world of rising gearing, what happens is many people in the world tend to borrow dollars. Now, they may use that to fund investments in India. They may use it to fund construction projects in Turkey. They may use it right across the emerging markets. But when we have a credit issue, when credit becomes less available, or people wish to repay it to reduce the risk, the net position is a buying of the dollar as people move back and pay off those liabilities. So if we are looking at Turkey, I think going into de facto default through the imposition of exchange controls, I think we're looking at a de-gearing event. It'd be very, very rare for the dollar to go down in that scenario. And then just once again to refer back to Jay Powell, he did make a very clear statement that if these things begin to happen, it's none of his business. Now, if he continues with that, the dollar could go very high, very sharply higher indeed. The two other major currencies in the world, I think, have unique problems. Japan has a unique problem that it has no savings left to fund its government, so its central bank is, and over the long term, that's always been bad for exchange rates. And in Europe, we obviously still have this problem that the fiscal integration / political integration of Europe has really hit a roadblock. And it's difficult to see how a single currency functions unless progress can be made on that integration. And yet, Italy is the latest poster child. It seems that the people are voting to go a different direction, away from integration, towards greater independence and sovereignty. It's very difficult to be bullish on the euro. So the dollar almost by default because of what's happening in the other two, but specifically because of a credit event, it has always spiked the dollar higher.
Where does this leave emerging markets? Because usually the two move in opposite directions.
Yeah, it is really sad that they're lumped together, I should say that. I mean, the fact that policymakers in Turkey have made some dreadful, dreadful mistakes. Why should that have any impact whatsoever on India, China, or anywhere else? Unfortunately, it does because the capital flows are lumped together. So, for instance, there are lots of emerging market bond funds and emerging market equity funds. And if they start getting redemptions, then it is kind of pulled pro rata almost from all of emerging markets. So emerging market risk has been pushed down to very low levels. I think Jay Powell is wrong. I think it's been pushed to very low levels by his monetary policy, by the fact that US interest rates are so low. So I think for all emerging markets, we'll see the risk premium reset. I know you're going to ask me about India in this context, but the ones where there should be the massive reset are the ones where the politics are really just completely in the wrong place. and I would pick out Turkey, but there's lots of others like the Philippines, like Hungary, I would say even potentially Poland. There's a big election coming up in Mexico in October, and politics could go completely to the wrong place. And what I mean is the kind of old politics of more control, restrictions on markets. That's the dangerous populism for investors. Now, I don't see any of that in India, and I realize people watching may have a different opinion, but I see the current political setting in India, even if growth slowed, I don't see the current political setting being pushed off course. And this is going to be a very, very important test now for all emerging markets. How do you respond if there is another downdraft? And I think the politics of India are such that it will pretty much keep to the same track. But there are other places in the world that would probably go a different direction.
How do you see India's macro setting now?
Well, I see it as very positive. I mean, I look at interest rates which have gone up, but they're still low by historical standards. Inflation is low by historical standards. Money supply growth is low by historical standards. Current account deficit low by historical standards. The ability to attract capital, which I think is the absolutely crucial thing, seems to be very good and can go higher. So I wouldn't even worry if the current account deficit got bigger. I think the policy settings are attracting capital. You know, it's strange for me to relate that when I started in this business, the Berlin Wall came down. And what we all knew instantly was that all these new emerging markets that were open for business were going to have to run huge current account deficits because they're going to have to attract a lot of capital. You know, they didn't have large savings, so they're going to have to use other people's savings. And as the current account and the capital account were mirror images of each other. And then what actually happened, particularly for somewhere like China, they ran huge current account surpluses, and the whole thing didn't make any sense. So we're kind of preconditioned to believe that a large current account deficit is necessarily a bad thing for an emerging market. But a country of the size of India, if it can genuinely attract capital, which has been the country's problem for many decades, but if that has genuinely changed now, then the country can be much more stable going forward. I would stress, and I think if you get a chance to chat to Rajan, you should really ask him about this. The key thing is to get long-term capital and not the portfolio capital. And it seems to be India is doing a good job at both. So the more of this long-term capital comes along, actually many of the historic issues that India has had become less and less important going forward. I mean, there's many other things I think are going well in India, which is, obviously we have issues with the banking system, but at least there are private sector banks in India who are doing a better job. That's not true in places like China. So I remain very optimistic long-term about India. I find myself embarrassed because I always say that, and then I say don't buy the stock market. And I find difficulties with the valuation in the stock market. We're looking at an emerging market problem coming along. India will be caught in the downdraft, but not as badly as others. That is a buying opportunity for long-term investors. If you had to, if I was asked to put money anywhere in the world for the next 10 years, I wouldn't hesitate to buy Indian equities on that time frame. So macro isn't always connected to the stock market. In fact, we can show there's 117 years of data for returns from it's nearly 20 stock markets across the planet now, and we can see there's virtually no relationship between GDP growth and the return you get from equities. And that's because the valuation varies so much that if you pay the wrong price for equities, you can still get it wrong in the long run. The economy's been doing well, but the market hasn't done so well. So cautious on the market, but not cautious on the macro settings for India. And this transformation in foreigners' willingness to invest in India can bring many, many things into line for very good outcomes. And long may it continue.
Let me ask you, it's a difficult question, but since you are predicting an EM crisis, a looming EM crisis, what's your best guess of the timing? Do you see it happening in 2018? I mean, if you had to guess, would you say it might happen this year?
Yes. I mean, the reason I would say that is because it seems to me that Turkey is already on the verge of default. So it's not forecasting that this will happen in Turkey. It is happening as we sit here. As you know, the President has called a snap election for 24th of June. I believe that if he can make it that far and if he gets re-elected, he will then take fairly extreme measures to shore up Turkey, which would constitute, in one form or another, exchange controls and would have an instantaneous impact on capital flows to all emerging markets. So normally I would say to you I couldn't possibly forecast, but on this occasion I'll say 24th of June.
Is there any chance in your eyes that the long US growth cycle that we've seen for the last many years, both from an asset quality, asset price point of view and from an economic point of view, that's beginning to come to an end, and you could even think of a US recession a year or two down the line? Yeah,
it's possible. You know the statistics for how long, on average, these expansions have lasted, and this is already a very long expansion if a very shallow one, not a very robust one. So it could really, I mean, it could end at any time. I think, what can I say? There are very few ways you can forecast a US recession. Obviously, an inverted yield curve is the #1 one, historically. People argue now whether the yield curve is as indicative of true economic conditions as it used to be. But I think we'd all be foolish to ignore the yield curve. So one of the things, rather than forecast it, is say, what should you look at? So look at the yield curve. I'm personally forecasting that the 10-year yield isn't going up. So that means you could have an inverted yield curve really quite soon, given on what Jay Powell is bent upon doing, and then we'd have to consider this. The reason I'm being a little bit cautious about all of this, and perhaps more cautious than usual, is thinking back to the late 1990s. We had this emerging market issue. Crisis, I think, is too strong a word. I think some countries have crisis, but it's a downgrading of growth for emerging markets, which is not the Asian crisis. It's not something like that. But when it happened last time, America imported deflation. Interest rates stayed fairly low, and growth in America stayed fairly high. And the whole, if you like, I think you could say, with the benefit of hindsight, that the whole economic cycle was extended by the emerging market crisis. The central bank was on hold, actually cut rates in 1998. So I'm a little bit concerned now that we're on the verge of this event in emerging markets, that could that extend this cycle? Once again, there's a difference between extending an economic cycle and saying the stock market's going up. That is a very different thing. But extending this economic cycle actually could be a side effect of something of a lower growth, lower inflation outlook for emerging markets.
Russell, on that note, thank you very much. It's a pleasure talking to you.
Thank you.